Are you trying to buy a home in British Columbia? And do you ever feel like the goalposts just keep moving? You've got a good income, you've saved up a down payment, but the number the bank says you can borrow just doesn't seem to add up? Well, you're not going crazy. There's one major hurdle standing in the way for so many people, and today we are going to take it apart piece by piece. Okay, let's just dive right in with the number that really matters. 15 to 20%. That's how much the federal mortgage stress test can slash your borrowing power, right off the top. It's a huge chunk, and it's pretty much the main reason for that gap between what you think you can afford and what the bank actually says you can. And that, of course, brings us to the big question. If the rules feel like they're stacked against you, what can you do? How do you actually get approved for the mortgage you need to buy the home you really want in this market? Well, the good news is there is a path. And here's our game plan for today. First, we'll size up the hurdle that's specifically facing BC buyers. Then we're going to decode what this stress test thing actually is. After that, the good part, we'll get into real strategies you can use to pass it. We'll even explore some key exemptions and alternatives you probably haven't heard of. And finally, we'll map out your path to getting those keys in your hand. Okay, first up, let's just talk about what so many of you are feeling. This hurdle in BC, it's real, and it is a big one. So what does that 15 to 20% really look like when we talk about actual dollars? Well, in a market like Metro Vancouver, it can mean having up to $170,000 less to spend on a home. I mean, that's not just a small difference. That can be the difference between a 2-bedroom and a 3-bedroom condo, or being in the neighborhood you love versus being pushed way further out. It's a massive deal. All right, so what exactly is this test that holds so much power over your home buying journey? Let's break it down, pull back the curtain, and turn this confusing role into something we can actually understand and, beat. At its core, the stress test is basically a financial safety net. The government created it to make sure that if interest rates were to shoot up in the future, homeowners wouldn't suddenly be at risk of losing their homes. So it forces you to prove you can handle your payments, not at your actual rate, but at a much higher kind of imaginary interest rate. Now, this is the part that trips almost everybody up. You are not qualifying for your mortgage at the nice-looking rate the lender is actually offering you. Nope. You're being tested against a higher benchmark. And that benchmark is decided by a really simple rule. And this slide just shows it perfectly. You have to qualify at whichever of these two is higher, the government's floor rate, which is currently 5.25%, or your actual mortgage rate plus a full 2%. So in that first example, you get a great rate of 3%. Add 2% and you're at 5%. But since that's lower than the 5.25% floor, you get tested at 5.25%. Now look at the second example. Your rate is 4.5%. Add 2 and you're at 6.5%. Since that's higher than the floor, bam, that's your new, much tougher qualifying rate. But wait, there's more. It's not just about the rate. Lenders use 2 critical ratios to measure your debt. The first one you see here is the gross debt service ratio, or GDS. Just think of this as your housing costs ratio. It means that all your future housing costs, and that's your mortgage payment calculated at that painful stress test rate, plus property taxes, plus heating, all of that can't be more than 39% of your gross income. And here's the second ratio. This is the final boss for a lot of homebuyers. It's your total debt service, or TDS. It takes all those housing costs we just mentioned, and then it adds on every other single debt payment you have. I'm talking car loans, student loans, credit card payments, you name it. And as you can see, that grand total cannot be more than 44% of your gross income. Okay, so that was the what and the why, and yeah, it's a tough test. But the good news is, it is not an automatic game over. Now we get to shift from just explaining the problem to taking action. Let's talk strategy. So there are 5 really solid strategies to get ahead of this. Number 1, boost your credit score. That can get you a better rate, which means a lower qualifying rate. 2, add to your down payment, which just means you have to borrow less. 3, and this one is huge, pay down your existing debts to fix those ratios. 4 is using a longer 30-year amortization, which is another powerful new tool. And finally, number 5, working with a mortgage broker who lives and breathes this stuff and knows how to navigate it all. Let's really zero in on the power you get from tackling your existing debt. It's incredible. Let's use a super common example, a car payment. So imagine you have a monthly payment of just $400. By paying off that car loan and totally wiping out that $400 monthly hit to your TDS ratio, you could boost the mortgage you qualify for by over $60,000. Just think about that. That one move can have a much bigger impact than trying to scrape together a few thousand more for your down payment. And here's another great tool in the toolbox, and it's a pretty new one. The government recently opened up 30-year amortization periods for first-time homebuyers and people buying new construction. By stretching the mortgage out over more time, you lower that monthly payment they use in the calculations. That improves your debt ratios and can boost how much you qualify for by about 8 to 10%. It's a real game changer. So beyond those core strategies, there are some really important workarounds and alternatives. Think of this as the insider's guide to the rules, and it's especially important for us buyers right here in BC. Now, this is just fantastic news for anyone who already has a mortgage. When your term is up for renewal, you used to be kind of trapped with your current lender if you couldn't pass the stress test all over again. But now, you are free to shop around and switch to a new lender with a better rate, all without having to re-qualify under the stress test, as long as you're not trying to borrow more money. Okay, now listen up, because this is the secret weapon for BC buyers. This is the local hack. The big banks, you know who they are, they're all federally regulated. That means the stress test is mandatory, period. But BC credit unions, they're regulated provincially. This means they don't have to follow the exact same federal rules. So for borrowers who have a 20% down payment or more, a lot of credit unions can qualify you on way better terms, sometimes even at your actual contract rate. This can be the single biggest key to getting your mortgage approved. So we've taken apart the problem, we've looked at the math, we've uncovered the strategies, and even some loopholes. Let's pull it all together and chart your personal path forward. All right, here's your cheat sheet. The most important things to remember are these. Know your qualifying rate. It's either 5.25% or your rate plus 2. Keep a laser focus on those debt ratios, under 39% for housing and under 44% for everything. To make the biggest dent, pay down consumer debt, like car loans first. If you're eligible, definitely explore that 30-year amortization. And please do not forget to check out BC's credit unions. And you know, this question really gets to the heart of it all. The mortgage stress test is a huge barrier, for sure, but it is not an unbreakable wall. You have options, you have strategies, and now you have the knowledge. So the only question left is, which one of these strategies is going to be the key that finally unlocks the door to your new home?